when an asset drops from over $585 down to just under 21 bucks in a single year, what exactly are you looking at?
Right. I mean, that's the big question.
Yeah, because is it the ultimate like undervalued, strong buy opportunity of a lifetime? Or is it just a falling knife perfectly disguised as a value trap?
It really is the ultimate debate in the market right now. And, well, to answer it, you honestly have to completely unlearn how you evaluate traditional investments.
Totally.
Like, you literally have to throw the standard playbook straight out the window.
Well, welcome to today's deep dive. It is April 16th, 2026, and today we are putting the Direxion Daily Semiconductor Bear 3X ETF, ticker symbol SOXS, under the microscope.
Such a fascinating one.
It really is. And our mission today is to look under the hood of this extreme financial instrument. We're going to analyze the latest news, the severe technical breakdowns, and really try to decipher whether this incredible price drop is, a momentary short-term weakness or just a permanent structural trap.
Yeah, and just to set the baseline for everyone, we are not looking at a standard index fund here.
Right.
SOXS is a leveraged, inverse exchange traded fund. It is explicitly designed to provide negative 300% of the daily performance of the ICE Semiconductor Index.
Is it 300%?
Exactly. So if the broader semiconductor market goes up 1% today, this specific fund is mathematically programmed to go down 3%.
Wow. And before we get to the absolute carnage of its price history, because, the numbers are truly wild, let me just remind you that whether you're listening on your favorite audio feed or, watching the video on our Deep Dive YouTube channel, please like this video, subscribe, and definitely leave a comment below.
Yes, we really want your feedback on this one.
Absolutely. Like, have you ever tangled with leveraged ETFs before? Just let us know in the comments. And of course, a quick but crucial disclaimer, this conversation is purely an intellectual exploration of market mechanics and data. It is absolutely not financial advice.
Right. We're just here to look at the mechanics. And honestly, the mechanics of this asset are so fascinating precisely because they're so counterintuitive.
They really are, because my first instinct when I see a 95% price drop is to open up the company's books.
Sure.
I went looking for a traditional corporate income statement or like a quarterly cash flow report just to see where the bleeding was coming from. But I couldn't find anything that looked like a normal corporate financial statement.
And you won't. That is the very first trap that catches everyday investors.
Really?
Yeah, because SOXS isn't a company that manufactures microchips or builds hardware. It doesn't have factories or, inventory or a loyal customer base.
Okay.
It's purely a financial vehicle designed to bet against the companies that do.
Okay, so if we can't look at a balance sheet, what are we actually supposed to evaluate?
Well, we have to look at its operational blueprint. We're dealing with an ETF that commands a massive amount of capital. We're talking roughly $1.64 billion in assets under management, or AUM.
Wow, that's huge.
It is. And it has an expense ratio of 1.000%.
Okay, wait, let me stop you there, because a 1% expense ratio seems incredibly high compared to, those passive Vanguard or Fidelity funds that charge a tiny fraction of a percent. Why is it so expensive to run?
Because it's a highly complex, actively managed product.
Oh, I see.
Yeah, the fund managers aren't just buying a basket of stocks and walking away. They are constantly trading.
Yeah.
But here is where the financials get genuinely strange, and this is exactly where retail traders get lured in.
The trap. Exactly.
If you look at the reported dividend yield for SOXS right now, depending on how you calculate the trailing distributions, it ranges anywhere from 5.48% to a staggering 16.01%.
Wait, hold on. A 16% yield?
Yep.
Let me play devil's advocate for a second here. Because in a world where, standard savings accounts or treasury bonds offer a tiny fraction of that, why wouldn't I just buy this at 20 bucks a share, sit back, and collect a massive 16% income stream?
It's tempting, right?
Yeah. If it's paying me that much, who cares if the stock price is struggling a bit? It's like buying a beautiful mansion on a cliff that's actively crumbling into the ocean, but the rent checks are great while it lasts.
That is a perfect analogy because, that yield is a complete illusion created by the underlying mechanics.
Okay, how so?
To understand why, you really have to look at how SOXS actually gets its exposure to the market. The fund doesn't go out into the market and short physical stocks in the traditional way.
Like they aren't borrowing shares of NVIDIA or AMD and selling them?
No, not at all.
Oh, really? Because I always assumed an inverse ETF was just this giant pool of shorted stock.
Mm.
How does it work then?
It gains its exposure synthetically.
Synthetically.
Yeah, it uses what are called swap agreements and futures contracts.
Okay.
Think of a swap agreement as basically a customized side bet made between the ETF and a major global investment bank. The ETF says to the bank, if the semiconductor index goes down tomorrow, you pay us. If it goes up, we pay you.
Oh, okay. So it's a contract based entirely on the price movement, not the actual shares themselves.
Precisely. And to enter into those contracts, the ETF has to hold a ton of cash collateral.
Like a safety deposit.
Exactly. They hold it in money market accounts or short-term treasuries, and that cash earns interest.
Oh, I see where this is going.
Right. Plus, the daily settling of those swap contracts can sometimes generate cash distributions, and that right there is what creates that massive 16% dividend yield.
Wow, okay. But if it's generating all this cash from interest and swap settlements, why is the overall price of the ETF dropping so catastrophically?
Because that cash generation is entirely eclipsed by structural price erosion.
Ah.
Let's think about a metaphor that explains the mechanics here. Imagine you're playing a casino game where you win a guaranteed $16 every hour just for sitting at the table. That's your dividend.
Sounds like a pretty great table.
It does. But the catch is, the casino is simultaneously draining 95% of your total bankroll from your pocket while you sit there. Yeah, the income stream is real, but your principal investment is vanishing so rapidly that the dividend is mathematically meaningless. It's just a distraction.
Wow. Okay, that makes total sense. I mean, the yield is a percentage, and if the pie is shrinking down to almost nothing, a large slice of a microscopic pie is still, microscopic.
Exactly.
And to fully grasp how microscopic that pie has become, we really have to look at the historical quote data, because the numbers are frankly hard to wrap your head around. As of today, April 16th, 2026, the latest price is $20.94.
Right. And you really have to put that in the context of the last year.
Oh, absolutely. Let me give you the 52-week range. The low end is $20.90. The high end is $585.60.
It's wild.
It literally went from nearly $600 to barely over $20 in a single 12-month period.
Yeah.
Today's trading range alone is hovering right at the absolute bottom, just bouncing between $20.90 and $22.43.
Yeah, that is the textbook definition of a severe, sustained downtrend.
For sure.
From a technical analysis standpoint, looking at the daily charts, the breakdown is complete. The asset is currently testing its absolute 52-week low of $20.90. And, what technicians look at here is historical support.
Right, meaning, has the price ever bounced off this floor before?
Exactly. And the answer is no. There is zero established historical support below this level. It is just in uncharted freefall territory.
And what if it tries to climb back up? Let's say it rallies a bit.
It faces a massive wall of selling pressure. Immediate resistance sits right above it at $24.81. And if it somehow breaks that, there's an incredibly heavy ceiling waiting at $36.07.
Jeez. Okay, well, I want to ask you about the momentum indicators, because reading through the technical analysis reports for this, they throw around some pretty ominous terms.
I have that.
For example, they mention something called a death cross. I know that sounds incredibly dramatic, but what is actually happening mechanically when an asset hits a death cross?
Yeah, it sounds like a movie title, but a dead cross occurs when a short-term moving average falls below a long-term moving average.
No.
Specifically, analysts usually look at the 50-day average crossing below the 200-day average.
So it's basically saying the recent pain is now significantly worse than the long-term pain.
Exactly. It shows that negative momentum is accelerating. Right now, SOXS is trading significantly below its 50-day average, which sits at $36.69, and miles below its 200-day average, which is way up at $82.02.
Wow.
Furthermore, if you look at the mass ED, that's the moving average convergence divergence, which measures the strength of a trend, it sits at a highly bearish negative 4.56.
Okay, so they all align.
Right. All of these tools are mathematically confirming that the downward pressure is sustained and powerful.
Okay, but I have a question about another technical indicator that seems to contradict that, or at least offer a glimmer of hope.
Okay, what are you looking at?
I'm looking at the RSI, the Relative Strength Index. It's currently sitting between 29.48 and 32.5. Now, I often hear traders say that an RSI under 30 means an asset is officially in oversold territory.
Yes, that's true.
Doesn't an oversold signal mean that the selling pressure has pretty much exhausted itself, like a rubber band that's been stretched way too far and is about to snap back?
That is a brilliant question, and it points to exactly how everyday investors get trapped.
Really?
Yeah. The RSI measures the speed and change of price movements. When it dips below 30, it does indicate extreme selling pressure. And yes, mechanically, when sellers run out of shares to dump, you often see a brief, violent upward snap,
Okay.
what seasoned traders refer to as a dead cat bounce.
Right, right. So if there's a bounce coming, why shouldn't I jump in right now at $21, ride that snap back up to $24, $25, and just take a quick profit?
Well, you absolutely could try that, and professional day traders do. But we have to separate a technical bounce from fundamental value.
Good point.
You have to ask, is that potential bounce a sign of an asset that is genuinely undervalued and ready for a long-term recovery? Or is it just a fleeting statistical anomaly?
Let's debate that, because when I see an asset down 95%, human psychology immediately screams discount. It can't possibly go much lower.
Oh, for sure.
It feels like a massive value play. Why is it wrong to think of SOXS as just a deeply undervalued stock waiting for a turnaround?
Because that mindset assumes SOXS behaves like a regular company.
Ah,
If a great technology company drops 95% because of, say, a temporary scandal, it still has patents, it still has engineers, it still has revenue.
all right, there's underlying value.
Exactly. Eventually, the market realizes the intrinsic value and the stock recovers. But SOXS has none of that. It is governed entirely by the mathematics of something called volatility decay or beta slippage.
Volatility decay. I've seen that term in the research. Can you explain how that actually works? Why is it the villain of this story?
It comes down to the mechanics of daily rebalancing. Remember our baseline. This fund promises to deliver negative 300% of the semiconductor index's return for one single day.
One day. Got it.
It does not promise negative 300% over a month or a year, just one day. To maintain that exact 3x leverage every morning, the fund managers have to buy and sell those swap contracts we talked about at the end of every single trading session.
So they're constantly adjusting.
Yes, they reset the baseline daily. Let's walk through the math step by step because this is the real light bulb moment.
Please do. I definitely need to hear the actual numbers to make sense of this.
Okay, let's say you have an imaginary index that starts at $100 and you buy a 3x leveraged bear ETF tracking it, also starting at $100.
Okay, $100 each.
On day one, the underlying index goes up 10%. It is now at $110.
Okay, so the index is at 110. And because I hold the 3x bear ETF, I lose 30%. My ETF is now worth $70.
Spot on. Now, on day two, the market realizes it overreacted. The underlying index drops 10%.
Okay, let me think. 10% of $110 is $11. So the index drops from 110 back down to $99. It's basically right back where it started.
Exactly. The index is roughly flat. But what happens to your 3x bear ETF? The index dropped 10%, so your ETF goes up 30%.
Okay, let me do the math here. My ETF was sitting at $70. A 30% gain on $70 is $21. So 70 plus 21, my ETF is now worth $91.
And there is the trap.
Oh, wow.
The underlying index went from 100 to 99. It barely moved. But your ETF went from 100 to 91. You lost 9% of your money in 2 days of flat sideways trading.
Wow. Because of the daily reset, you are literally compounding your losses.
Yes.
When you lose, you fall from a high number. But when you win, you're calculating your percentage gain from a much smaller base.
Exactly. The math of percentages is asymmetrical. If you lose 50% of your portfolio, you need a 100% gain just to get back to zero.
Right.
In a volatile market that moves sideways or, a market that constantly trends upward like semiconductors have done, this daily rebalancing acts like a mathematical parasite. It causes permanent value destruction.
That is terrifying. It's like trying to fill a hole with a shovel that shrinks every time you scoop some dirt.
That's a great way to put it.
So if the mathematics of daily rebalancing basically guarantee that this asset will trend towards zero over the long haul, why do retail traders still view this as a buy and hold capitulation play?
Mostly a lack of education regarding the mechanics we just outlined. Our brains are hardwired to look for patterns of mean reversion.
The idea that what goes down must eventually come back up.
Exactly. When they see $20 after seeing $585, they just buy the dip. They're completely unaware that the asset's underlying architecture basically guarantees a long-term decline.
Wait, if the math guarantees a decline towards zero, how is this ETF still trading? I mean, why hasn't it literally hit zero and been delisted from the exchange?
It avoids hitting absolute zero through a mechanism called a reverse split. And in fact, we saw discussions of a reverse split for SOXS back in February of 2026.
Oh, I saw that in the news updates. How does a reverse split actually keep the fund alive?
It's essentially an accounting trick to artificially inflate the share price. Let's say the ETF drops all the way down to $2 a share, and the exchange threatens to delist it. The fund will execute, say, a 1-for-10 reverse split.
Right.
So if you held 10 shares worth $2 each, $20 total, the fund takes those 10 shares away and replaces them with one single share worth $20.
Oh, so the price suddenly looks 10 times higher on the stock chart, but the actual dollar value in my account hasn't changed by a single penny.
Exactly. It's the equivalent of taking 10 small slices of a pizza and squishing them together into one giant slice.
You don't have more pizza.
You don't have more pizza.
Yeah.
But it resets the price high enough so that the volatility decay can just start grinding it down all over again. It is purely life support.
That is a massive red flag, and I guess it perfectly explains why the analyst ratings we pulled for this deep dive overwhelmingly scream strong sell or avoid.
Oh, yeah.
The consensus across the board is that this ETF is strictly overvalued for long-term holding.
Without question, leverage ETFs are specialized tools for tactical daily moves.
Yeah.
They are simply not valuation-based investments.
Okay, so this brings me to a really big question. If the mathematical deck is so heavily stacked against holding this long-term, what exactly is the bullish argument?
Good question.
Because somebody out there is buying this. There is $1.64 billion of assets under management in this fund. Who is actually buying this and why? Let's break down the bull versus bear scenarios for the market outlook.
Sure. Well, it's helpful to start with the bear case for SOXS, which ironically represents the most likely high probability scenario going forward.
The scenario where SOXS continues to plummet.
Right. The bear case for this specific ETF is simply that the semiconductor sector remains relentlessly strong. We're talking about the unstoppable systemic growth in artificial intelligence and high-performance computing infrastructure.
We're talking about the absolute titans of the industry right now. Companies like NVIDIA and AMD.
Exactly. These giants are driving a generational build-out for AI data centers. As long as those companies continue to post massive revenues, beat earnings estimates, and offer strong forward guidance, the underlying NYSE Semiconductor Index will remain at or near record highs.
And SOXS suffers.
Yes. Every day that index stays strong, or even just stays flat, the volatility decay in the SOXS crushes it a little bit more. The bear case is just a continuation of the status quo. The tech sector thrives, and the inverse ETF dies.
But there has to be a bull case for the ETF, right? I mean, a scenario where that $1.64 billion of capital actually sees a massive return. What causes this thing to spike?
There is a bull case, but it's vital to understand that it has nothing to do with the ETF suddenly discovering some fundamental intrinsic value. The bull case is purely tactical.
Meaning what?
It relies entirely on external macroeconomic shocks. There is the potential for a sudden 20 to 30% explosion in the price of SOXS, but only under very specific, highly disruptive conditions.
Disruptive, like what are the catalysts?
The primary catalyst would be if major tech companies suddenly and severely miss their earnings expectations, causing a sudden panic sell-off in the tech sector.
Okay.
Another major catalyst would be geopolitical tensions, specifically U.S.-China trade issues regarding Taiwan.
Oh, right, because so much of the world's advanced semiconductor manufacturing happens in Taiwan.
Exactly. If there's a sudden blockade, a tariff war, or disruption in the supply chain, the semiconductor index would plummet, and SOXS would skyrocket inversely by 300%.
I'm starting to see the picture here. So the people buying this aren't retail investors looking for a 10-year retirement hold.
Definitely not.
Institutional traders aren't looking at this and thinking, I believe in the long-term failure of the microchip industry.
Not at all.
They are using this as a very short-term hedge. It is a quick, violent insurance policy against sudden corrections in the semiconductor market.
It is a fire extinguisher.
Oh, I like that.
Yeah, you don't buy a fire extinguisher hoping your house burns down. And you certainly don't buy it expecting it to appreciate in value over 30 years. You keep it in the kitchen just in case there's a sudden unexpected blaze.
Right.
If the market gets spooked by an earnings report or a geopolitical event, institutional capital will flood into SOXS for a few hours, maybe a few days, to offset the heavy losses they're taking in their long portfolios.
But the moment the panic subsides and the market stabilizes,
They dump the extinguisher. They sell out of SOXS immediately before the volatility decay starts eating their capital again.
that analogy clarifies everything. So summarizing our deep dive today, the outlook for this instrument is incredibly stark.
Very.
In the very short term, sure, there might be a brief dead cat bounce driven by that oversold RSI or a tactical spike if there's a sudden panic in the tech sector. But the long-term perspective is entirely dominated by two unstoppable forces: the thriving underlying tech sector driven by the AI revolution and the structural mathematical decay of daily 3x leverage.
That structural decay truly cannot be overstated. I mean, we've proven the math. Even if semiconductors trade perfectly flat for a month, going up 1%, down 1%, back and forth,
Mhm.
the daily rebalancing of the swap contracts means SOXS will lose value.
Wow.
There's a mathematical certainty built right into the asset's DNA.
We have covered a massive amount of ground today. I mean,
Yeah.
we unpacked that staggering 95% price drop from $585 to $20.
We sure did.
We dug into the mechanics of swap agreements to demystify the illusion of its high dividend yield, proving that it's essentially a mirage masking deep capital erosion. We looked past the raw numbers of the death cross to understand the extreme technical breakdown and the heavy resistance waiting for any attempted rally.
Yeah.
And most importantly, we broke down the actual mathematics of volatility decay to explore why SOXS is a highly dangerous tactical hedge rather than a long-term investment.
It really serves as a perfect masterclass in why understanding how an asset works under the hood is just as important as understanding the market it tracks. You can be 100% right in your prediction that the semiconductor sector is due for a pullback next month, but if you buy and hold a leveraged instrument like SOXS to play that prediction, the daily decay might still cause you to lose a fortune.
It is a brutal but brilliant reminder to never take a price chart at face value. Before we wrap up, I want to ask you all one more time, whether you're streaming the audio or watching our Deep Dive YouTube channel, please like, subscribe, and drop down into the comments.
Let us know what you think.
Yeah, we genuinely want to know. Have you ever tried trading leveraged ETFs like this one? Did you get caught in the mathematics of volatility decay, or did you time a tactical hedge perfectly? Share your battle stories with us.
And as you think about the complex mechanics we've discussed today, I want to leave you with one final thought to ponder.
Okay.
We've clearly established that instruments like SOXS are continually crushed by the sheer resilience, profitability, and momentum of the current AI hardware giants.
Right. NVIDIA and AMD seem totally untouchable right now.
They do today. But history shows us that technology is inherently disruptive. It never stands still.
That's true.
If the current generation of silicon-based AI chips is powering an unstoppable bull market right now, what happens to extreme financial leverage when the next unforeseen technological paradigm shift occurs?
Wait, what do you mean?
Well, what happens if a sudden unexpected breakthrough in quantum computing or, a totally new non-silicon processing architecture makes today's cutting-edge AI chips completely obsolete overnight?
Oh, wow.
Are we looking at a future where a permanent structural bear market for traditional semiconductors is actually possible? Or is that black swan event the one singular disruption that would turn the falling knife of SOSS back into a $585 asset just waiting in the wings right now?
A completely obsolete semiconductor industry. That is a wild scenario to imagine. A crumbling cliff or fire extinguisher right before the blaze. It is something to definitely keep in mind the next time you see a 95% discount and your brain screams, strong buy.